because our commodity markets are a little bit tighter than they were over the past decade, and because of this how quickly M2 is rising, we're starting to see bottlenecks in different sort of supply chains or commodities, and so that translates more towards actual price increases. And there'll be some areas like say lumber that get really silly high, and they'll come back down. Whereas if you look at like a broad set of prices, those will generally be elevated after each one of those bursts of inflation.
Yeah, so I guess it's best to start with definitions. And so I've done a lot of research showing how price inflation correlates with increases in broad money supply, although there are some exceptions. And so generally, there's monetary inflation, which is just an increase in the broad money supply, especially on a per capita basis. Then you have price inflation, which is basically the prices of things, usually commodities, but it trickles up to everything else, prices, wages, things like that going up. And then you have asset price inflation, where if you have a lot of money supply growth, but you manage to keep, say, commodity inflation low because maybe there's a lot of commodity abundance at that time, then that can instead translate into asset price inflation, where we pay more for the same stock. We're paying to pay more for the same stream of earnings in a stock than we otherwise would. And basically, it can kind of cause bubbles in financial assets. And so, the last decade, we're at the stage where monetary inflation was moderate. It wasn't low, but it wasn't super high either. And because if you look at broad money supply rather than just base money, so a lot of people look at the base money charts and it just goes like parabolic, but broad money supply was growing at kind of a moderately high pace. And because we were in a period of commodity abundance, a lot of that increase translated into asset price inflation instead. But now, as we go into the 2020s, money supply growth has accelerated in many parts of the world, especially developed markets who've had more kind of fiscal space to do some of the fiscal activities they wanted to do. And because our commodity markets are a little bit tighter than they were over the past decade, and because of this how quickly M2 is rising, we're starting to see bottlenecks in different sort of supply chains or commodities, and so that translates more towards actual price increases, where commodities go up, wages can go up, and basically shipping costs can go up, all sorts of things can trickle through, and you find yourselves with these periodic shortages.
What you can observe is that there's a strong correlation that as you get more debt, you also generally get less growth. And of course, the tricky thing is it's saying that, are the reason that policymakers are taking all that debt out is because they have slowing growth, or is that debt causing the slower growth? Okay. And so I think the more fundamental underlying thing is demographics. And some of the fiscal, decisions that some countries have made. But then on top of that, you can exacerbate that with certain monetary responses, things like that. And so overall, debt I view more as, what it's being spent on more so than the exact level. In addition, we can separate public debt from private debt because they actually have very different effects on inflation versus deflation. So if you look back, for example, in the 1930s and 40s, you had kind of a 1-2 punch at the end of a long-term debt cycle. So it wasn't like all the debt went up at the same time. Instead, you had a private debt bubble and then a public debt bubble. So the private debt bubble peaked in the really early 1930s, during the big crash and the Great Depression, the bank failures. So you had debt as a percentage of GDP from the private sector reach very high levels, while public debt was still pretty low. But then all the responses to kind of try to drag the economy out of that, create a lot of new base money, expand the broad money. Then you had, of course, populism. Then you had World War II. So of course you had that kind of external fiscal, response. And then therefore in the 40s you got that public debt bubble. And a big difference is that the private debt bubble, especially as it unwinds, tends to be disinflationary, whereas the public debt bubble tends to be more inflationary. But then in the 2020s, now we're getting kind of the public debt bubble. We're getting kind of the 1940s environment of, massive increase in broad money supply, massive increase in federal deficits to try to kind of drag the economy out of that. And that tends to be more inflationary in the grand scheme of things. So that's kind of how I'm looking at play out, is kind of monitoring private debt and public debt somewhat separately and seeing how they're interplaying with each other.
And so my overall base case of the 1940s, in the 2020s, is it looks somewhat like the 1940s in the sense that you have these periodic spikes of inflation based on fiscal expansion. So based on fiscal driven money supply going up, which means you're running large deficits to basically pump up the money supply, which is different than say the 1970s, which is more so bank lending based. And there's there will be some areas like say lumber that get really silly high and they'll come back down. Whereas if you look at like a broad set of prices, those will generally be elevated after each one of those bursts of inflation.
Ever since around the year 2000, the share of global central bank foreign exchange reserves that's in dollars or treasuries more specifically has been declining as a percentage of the total. And so even though it's still the largest single allocation, it is going down over time. And if there were to be more SDR issuance, that could kind of accelerate that because that kind of inherently is a more decentralized reserve asset. Prior to the pandemic, they couldn't call it. I mean, you're right in the middle of an economic expansion. You can't say we're just expanding the balance sheet because, for fun. We're just doing it, basically they didn't have the cover to say, yeah, we're actually doing it because we have a problem. Instead, once you had the pandemic, you can say, okay, well, now we have an economic shock, so we have to do QE. So they were, more directly calling it QE at that point.
Right.
And then even then in March 2020, when the markets crashed, initially bonds did well. I mean, bonds sensed out that crash coming, bond yields went down, so bond prices went up. But during the heart of the crisis, as the dollar spiked, you had the foreign sector having to begin kind of forced selling some of their treasuries in order to raise dollars. And you had other entities then, with leveraged, kind of risk parity funds having to sell some of the treasuries. And so you actually had a sell off in the treasury market at the worst part of the recession. And so the Federal Reserve had to come in and buy $1 trillion worth of treasuries in 3 weeks to kind of re-liquefy markets. You had in addition to the yield spiking, you had the bid-ask spread just blew out. So the market was essentially liquid and broken, and it's supposed to be one of the most liquid markets in the world,
Right.
the treasury market. So as consumers, we generally would prefer price deflation while still having our jobs. So we
Right.
don't want some sort of economic contraction. But we want technology and things like that to lower prices over time so that our money goes further. And
Right.
that's normally the best case scenario. The only time that's bad is if you have a debt bubble, right? Because then the real value of your debt goes up relative to your incomes and things like that. So if you had avoided that in the first place, then that deflation is really good. But what policymakers are afraid of is that because we've had this this kind of mix of lower interest rates and these different types of policy mixes, we've kind of encouraged this big debt buildup. And now they basically have to, in their view, inflate it away before they can kind of stabilize.
There's that parable of like three different people are like blindfolded and they're touching like an elephant, and they're all touching like a different part. Like someone's touching the tusk and someone's touching the ear and someone's touching like the skin, and they're all describing something that sounds totally different, but really they're just each describing a small part of what it is. And so I think that's the biggest risk that economists or forecasters have, is that they can be wrong without they're what they said might not be wrong, but it's just incomplete. And so that's always kind of the most challenging part of economic forecasts, is that one or two missing variables can change the direction, even if like say the 5 variables you were looking at ended up being correct. And so I think it's really important to step back and try to have the biggest possible umbrella framework, and then kind of monitor that going on, and then test it. Like basically see if it's playing out the way you thought, and if it's not, then you quickly back up and say what variable am I missing, what is deviating from what I thought, and how can I adjust to compensate for that. Or if it is working, then that's a good feedback for the theory, and then you just got to keep monitoring to make sure things don't change. Price inflation correlates with increases in broad money supply.
What you can observe is that there's strong correlation that as you get more debt, you also generally get less growth.
Running large deficits to basically pump up the money supply, which is different than say the 1970s, which is more so bank lending based.
And if there were to be more SDR issuance, that could kind of accelerate that because that kind of inherently is a more decentralized reserve asset.